These are the major drivers of gold that investors need to be watching for and paying attention to into the new year. Jim Steel, Chief Precious Metals Analyst at HSBC, joins me today. Jim, it's not often we have you on Kitco. What a tremendous honor. Thank you for coming on.
Well, thank you for the gracious invite, David.
Let's start by looking around at the macroeconomic landscape. Jim, what are the major factors behind the gold price? Let's start with that.
Well, the gold rally, which has been going on for quite some time now, most gold rallies are supported by two features: debt and liquidity, and some varying degrees of one, the other, or both. And right now, the gold market is the beneficiary, and has been for quite some time, of both debt and liquidity. And by that, I mean we've had highly accommodative monetary policies going on for a very long time. They have not reversed course. In addition to it, it's not just a US phenomenon by any means. We've had monetary easing across the globe in both developed and developing economies. Now, this has led to really significant liquidity, which has reduced interest rates, and not only in nominal terms, but also in real terms in some countries. We have actual negative, the other way around, not just in real terms, but also in nominal terms. We had a good percentage of the global sovereign bonds last year and earlier this year were negatively yielding. And in a situation like that, one would be tempted to own gold because it reduces the opportunity cost of owning gold. You can tell by this white hair of mine, David, that I've been looking at the gold market for a long time. And in the 1990s and earlier in this decade, a great argument against owning gold was relatively high interest rates, because the opportunity cost was simply too much. Well, that doesn't exist anymore. And this is really very important. So in addition to this pool of liquidity, which keeps rising from the world central banks as we first battled a recession and then now the economic impact of COVID-19, we also have fiscal issues. We also have excessive, a sharp increase in government debt around the world. In the case of the UK, it's gone to 100% of GDP. In the case of the United States, it's gone up also to the levels not seen since the end of World War II. And as you can imagine, higher debt is also stimulative for gold for many reasons that one could write a book about, and books have been written about this. But debt and liquidity, and they're both coming in high levels at the same time.
Jim, surely your white hair wasn't a result of this year's price movement, because we've seen a tremendous rally this year in the gold market. A lot of investors in the gold space have benefited this year. Now, I wonder why it's taken 10 years, almost 10 years, 9.5 years from the 2011 high to reach pretty much the same level again. You've mentioned debt and liquidity as primary drivers of gold. We've seen both of those things in the last 10 years with QEs 1, 2, 3, and 4. But yet gold has been stuck in a range for 10 years, Jim.
Well, you've got to look at it maybe a little bit longer term, David, and the market never really sold off. What we had in 2012, 2013 was the major sell-off. We got to a point, the ETFs had grown significantly, and what happened then was that there was there was expectations of a shift in monetary policy. And that led to a significant liquidation in ETFs in the 2012-2013 period. And then the market retreated quite significantly from that 1920 high, which, by the way, is still the high in real terms right now, although we broke over it in nominal terms this year, down to, and it threatened going to near 1100 at the time. And that's when China emerged as a massive physical buyer. So they put the floor in the price, and the market actually did recover. Just because it hasn't been quite as volatile, I don't think is to say that it hasn't been useful.
The physical market, is that a big driver of the gold price?
Well, yes, it is. Now, it's very easy if one is on the investment side of things to look at the interplay between central banks and between hedge funds, portfolio managers, insurance companies, high net worth individuals who are trading the market or accumulating it for investment reasons. But let's not forget, gold is a commodity, silver is a commodity, and they're physically used. And what we have really is the locus of investment is sort of New York, London, but the locus of demand is India, China. About 2/3 of all the physical gold that's purchased in the world is bought between those two countries. And then if you take Southeast Asia and the Middle East, Africa and other non-OECD countries, you have the vast bulk of physical demand. And they operate under different parameters than, say, an investor in New York or London. And what we've seen, David, and this I think has not gotten enough play, is we have seen a severe contraction in physical demand for gold in the form of jewelry and other physical forms because of the high prices.
Now, just going on the two or three factors that you mentioned, physical demand, debt, liquidity, I'm going to guess that you're long-term bullish on gold because as we've seen this year, we've seen record levels of debt, stimulus, monetary stimulus, interest rates, analysts forecasted are about to remain low for the foreseeable future. Negative real interest rates are here to stay. And on the demand side, the physical demand has never been better going forward. We have a lot of people buying physical in the wake of the pandemic, and China and India are continuing to grow as markets. Does that set up your thesis well?
Well, I would agree with you on the first 2 points, but I would humbly beg to differ a little bit on the third. We're not seeing much of a recovery. Now, let me put it in these terms. Gold investors in the West are relatively affluent. But many people who buy, and there's a big delineation, there's a good separation between jewelry and investment in Western markets. But it's mixed in Asia. It's part jewelry, it's part adornment, it's part investment because most buyers don't have separate investment accounts. And given the weakness in local currencies vis-a-vis the dollar, plus the increase in the dollar price, it's absolutely hammered. We had, generally speaking, more than 50% of physical demand for gold is in the form of jewelry. Well, that's going to be much, much lower this year. A 10 gram, most bars that are bought in India are 10 grams, and it went over 50,000 rupees. That puts it well out of the reach of many people. We've had, according to the World Gold Council, jewelry demand was down almost 50% in the first half of the year. And that's half of physical demand. In China, the typical bar is 50 or 100 grams, so a bit bigger, but the high price has a very much a crimped demand. Now, if you do the arithmetic, I'm not going to fall into the habit of saying do the math, because it's not math, it's just arithmetic. If you look at what has gone into the ETFs, minus what has been subtracted from the jewelry market, you see it's largely been a shift of one type of gold for another type of gold, or one home for gold. So it's going to be difficult, I think, for us to see a physical demand is beginning to recover in Asia, but it's going to be very, very difficult to get back to.
Okay. I understand. Now, I'm going to posit a counter argument to your monetary part of the equation now. I'm going to give you a bearish case for gold, and maybe you can tell me why I'm wrong or why you would disagree with me. As we enter into 2021, deflationary pressure still persists. The economy is still weaker than pre-COVID levels. President-elect Joe Biden is expected to ameliorate tensions with the United States, which might put upward pressure on the US dollar. That could all weigh down on gold. And of course, later on in the year, as we see inflation eventually creep back up as a result of fiscal stimulus from this year, the Federal Reserve is likely to raise interest rates. Can you comment on those points?
Sure. I think that you're partially right. And which is about as far right as my wife ever lets me be, partially, at most. And this is why, and some of the points you brought up is exactly why we have what we think is a sober and a well-rounded view on the gold market. We're not wildly bullish. We're just positive to friendly. Now, what I think you've struck on is the trade and foreign policy from a Biden administration. Now, gold is sensitive to geopolitical risk. Now, sometimes I get asked, well, Brexit happened and we only went up $10 and then we came back, or something happens in the Middle East or in Eastern Europe and we only went up and then came back. But that's not the point. You don't look at one particular event. It's the confluence of events. And more events are occurring that have geopolitical ramifications. And that's raising the geopolitical risk thermometer globally. And that is supportive of gold. And so don't look at any one event.
Okay.
The other is trade. If you look at periods when trade is going gangbusters, when global trade is increasing above GDP levels, economists tell us a couple of things are going to happen. One is that inflation is going to be relatively low because the cheapest goods and services are being traded. The other one is there's a lot of cross-border immigration, a lot of cross-border investment. Assets, stock market tends to be strong, led by export-led companies, and the dollar tends to be strong because you need the dollar in order to trade. So under circumstances like that, which was for much of the 90s and earlier this century, one would not need to own so much gold because also the geopolitical risk goes down. You don't have big problems usually with people that you trade a lot with. Now, when trade contracts, however, as it did during the global financial crisis, and it has again, then gold market takes off quite strongly. So if you look at last year, every time there was a rise in trade tensions, gold was the beneficiary. Every time they seemed to be ameliorated, gold retreated. If we're going to get some rapprochement on the trade issues between the United States and other countries, and it's not just one country, it could be from several. And we also get a sort of charm offensive from the Biden administration to U.S. allies or to others, and the geopolitical risk thermometer comes down, and there's progress made on the trade front, then that would be a negative for gold, certainly. So to that point, I think you're right. Okay. Now, our fixed income analysts who've really been spot on in the past couple of years are forecasting 75 basis points at the end of next year and the year after for the 10-year. So that does not change monetary policy. That would not imply a significant enough change to support gold. And the point I want to make here too is that this fiscal spending and the monetary easing that's been going on, it's going to work through the system for quite some time. So even if they were to be reversed, it's going to take time. So I would agree with some parts of what you said.
Okay.
And other parts, I would insist that the monetary outlook, as far as we can be able to see, is going to remain positive.
Okay, fair enough, Jim. Now, I'd like to touch on the trade issues you brought up, and you mentioned a very good point, which is that in the past 4 years during the Trump administration, whenever the geopolitical risk premium has gone up as a result of trade wars, gold has also gone up. But I'd like to point out that at the same time, when trade wars, disputes from the trade wars have escalated, the stock price from equities, the equities markets have also gone down. So we have seen more or less an inverse correlation during that time. In the past few weeks, we've seen a lot of, actually, as we were talking offline, for a large part of this year, gold and equities have traded in tandem. Can you explain why this inverse correlation has shifted this year and whether or not it's going to persist?
It's interesting, isn't it? And I think a lot of it has got to do with risk on and risk off. And I should make a point here on the trade issue. It's been going on for a long time. I wouldn't necessarily lay all the friction on one administration or another. And certainly, but it is fair to say that trade tensions have been higher than they should be, and that's played a role than they have been historically, and that's played a role in gold, and we should watch that going forward. The issue with equities, I think, might be related to risk on and risk off, so-called RORO. When you have a risk on, and that is to say, investors are happy to, you get less of a safe haven bid for the US dollar. If you look at it this way, the US dollar is the world's supreme paper asset. Gold is still the supreme hard asset. You get less demand, though, for treasuries. You get less demand for the dollar. Yields go down, maybe the dollar softens. That plays a role in the equity markets going up, but it also plays a role in gold going up. So I think that's why you could draw a link between gold and the equities, which is not really there. It's related to risk sentiment. Now, the other thing, though, that is more directly related between gold and equities is that gold is a great insurance policy. I mean, it's proven that countless times over decades, if not centuries. So everyone is participating in the equity markets, but might be a little uncertain or unclear about where the market's going to go and wants to take out a bit of insurance. Some managers have been turning to gold.
Let's touch on the other major factor behind gold prices, which is the US dollar. Now, you've briefly touched on this prior to this question, but let's talk about the negative real interest rate environment that we're in. Most major currencies, including the euro, are in a negative real interest rate environment. So let's talk about the differentials. Do you consider the US dollar to be, strong right now? And can the differentials continue to be strong relative to other currencies?
Well, that is out of my purview, David. We have a more neutral view going forward with the US dollar possibly strengthening against within the G10. Strengthening against some, weakening against, maybe a little bit weaker than the other. So broadly negative and broadly neutral within a range, and not. So we wouldn't look for it to necessarily have a huge impact on gold unless it made a big move either way.
All right. So Jim, putting all this together now, do you have a forecast for the price of gold for the next year?
Well, we have a average price for next year of $1,965. That is our published forecast.
Okay.
So that means that the market would move within an acceptable range above and below that, but it would average out to that price.
All right. If this is more on the conservative range of analysts that I've spoken to, you gave me a bullish case. I'm curious as to why the average wouldn't be higher than basically where we're sitting at today.
Well, I suspect a lot of the prices you might have gotten have been year ends, rather than averages. We're looking for strength sort of more in the early part of the year, and maybe more moderation in the second part. But don't forget, that's an average, which means that the market would likely spend time above $2,000 for some time, and sometime, under 1,900.
I understand. Does the seasonality aspect play into it?
It used to. We used to get movements near Diwali, the Festival of Light in India, and also the Chinese New Year. And you do get some stocking up, the Lunar New Year. You do get some stocking up beforehand, but it's not nearly as influential as it used to be.
Okay. Finally, let's talk about ETF flows this year. What have you been seeing in the inflows front?
Well, this is really very, very interesting. I mean, I think the two of the most interesting but not spoken about, not talked about, is the issues of central banks, recycling, but also ETFs, although the ETFs have gotten more press. I mean, we've had a spectacular increase. They've gone up from 81 million ounces and change at the beginning of the year to around 111 million, I believe at the moment, maybe a little bit under that. And a 30 million ounce increase. Absolutely phenomenal. Absolutely phenomenal, David. And but it has moderated recently. And this shows what I was saying. This is an investor-led rally. This rally is not led by millions of people buying more jewelry, by millions of people buying small bars. It is led by investors who are looking at the monetary and fiscal and geopolitical outlook, and they're buying gold, and it's coming. Much of it is coming through the ETFs. Now you've got to. I mean, we've seen some moderation very recently, post-election. Maybe there's been some calmness, and we're still positive on ETFs, but it would be very, very hard to keep up the level of buying that we saw, in the first 6, 7, 8 months of the year.
Mm-hmm. ETF inflows, are they most positively correlated with the price action?
Well, you could argue that it is the money going into the ETFs that also determine that price action. So the causation is a little bit difficult to argue both ways. One could argue it both ways. I do continue to think that it is the monetary and fiscal outlook that drives the money into the ETFs, and that determines and that influences the price. But
Okay.
but it's a very good question, because you can argue that causation all day long, either way.
Yeah, it's very difficult to prove. Central bank demand tapering off this year, or this past year, 2020, except for Turkey and a few others. What do you see going forward?
Well, we've had 2 spectacular years, and again, you've got to look at it in perspective. Like the ETFs, they may moderate, but they're coming off of a very, very, very high base level. Last year was a record number for over 650 million, over 650 tons, 660 something, I think. And the year before was only 10 tons less than that. Absolutely phenomenal central bank demand compared to historically. Now, a couple of things have happened this year. One is that, again, getting back to trade, it's interesting how these things loop back. Countries that were purchasing some of this gold had current account surpluses, and therefore they had the spare foreign exchange reserves, i.e. dollars, in order to be able to do it. With the contraction in trade, there's less of those dollars to go around. Also, some countries have been recently have sold. Some central banks have sold gold, again, possibly because they want to raise the dollars. And then 2 of the major central banks that bought gold are petrocurrencies, are reliant in part on petroleum exports. And the oil price has moderated, it's come down. So that reduces that level. And I think a lot of that explains the pullback in central bank buying. So higher oil prices, if they were to come, I'm not the oil analyst, so I can't say. And also a recovery in trade, which would increase some dollar foreign exchange reserves, would complement higher central bank buying maybe next year.
Okay. Jim, I want to thank you so much for coming on the show today. We ran through the gamut of gold price drivers, and I just want to thank you so much for your time.
Thank you very much, David, and courteous thank you to Kitco and to your viewers.
Thank you for watching. I'm David Lin. Stay tuned for more.